Welcome to Trading Nation. We're pleased to be joined now by Ed Yardeni, president of Yardeni Research. Ed, thank you very much for joining us here on Trading Nation. A lot to discuss. One of the biggest questions we've had is why bond yields are dropping in the last 30 to 45 days, even as the stock market seems to be holding up okay. What do you think is behind that?
Well, interestingly, it seems that the bond market just hasn't really bought into the idea that inflation is coming back or that economic growth is going to be surprisingly strong. The stock market seems to be more attuned to that kind of scenario. But we just had some very weak car sales reported for last month. And anecdotally, we're getting lots of stories of retailers in distress. The in-store retailers are confronting a tremendous amount of competition from the Amazons and other online sources of merchandise.
But you're still expecting economic expansion?
Yeah, I just think that, after the election, a lot of people started to revise their GDP numbers up, figuring fiscal policy was coming in terms of infrastructure spending and tax cuts. And I think now we're getting a little dose of reality and realizing it's going to take a while to see all that unfold. Meanwhile, the economy hasn't changed radically since the elections. I mean, there's been all these soft data surveys suggesting that confidence is up all over the place, but we're not seeing it in the hard data. We're not seeing it in car sales. Some of this commercial and industrial loan data has been weak. So I think it's maybe suddenly 2% looks like a more credible scenario for growth than 3%.
And, there's been a hot debate, too, about market valuations as the market has climbed so much since last year. You've got a valuation or a couple valuation charts from your latest research. Fundamentally, do you believe the U.S. stock market is overvalued?
Well, the stock market is ahead of the fundamentals, which I guess is a coy way of saying that it is overvalued unless the fundamentals really do show up. I think the market has rallied since Election Day on the perceptions that Trump is moving forward on deregulation, which is probably going to be worth something in terms of higher earnings. But the big bang per buck has got to be tax reform, and that's yet to really be thrashed out.
Yeah, and what do you think is the biggest risk then to the equity market right now, Ed?
Well, I don't know. I think it's more sort of the internal sector rotation. We had a big run-up in financials, for example, on the perception that the Fed was going to maybe raise interest rates more aggressively and that bond yields would rise even faster, so we'd have an ascending yield curve, which is generally viewed as very good for financials. But all of a sudden, maybe the Fed isn't going to do 2 more rate hikes. Some of them were even talking about 3 this year. Maybe there's only 1 more coming. And meanwhile, the bond market's telling us that economic growth still is likely to remain slow without much inflation.
Yeah, it's starting to get a little more interesting the last 2 to 3 weeks here, I think, with a lot of the data that you have so smartly pointed out. Ed Yardeni, we always appreciate your time on Trading Nation. Thank you.
My pleasure.
All right, folks, thank you for watching. I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.